Good day, fellow investors. Beating the market by investing in businesses, not in indexes, not in the market, is what I have been discussing on this channel for the last 4 years. And this is actually something that I speak from my experience, because investing in individual businesses has worked extremely well over the last 20 years for me. I can't even compare what benefits I received from that compared to what would have been the case if I invested in any index out there. So in this video I want to discuss my recent analysis of the complete Dutch stock market, compare investing in free stocks, free businesses, to investing in the index, to give you a perspective of what is really the core of investing for me, and really go into hands-on this time. And if you enjoy this research, trickling down into stock analysis, trickling down into investing in businesses, please smash that like button. Also consider subscribing, because I finished the Dutch market. We are now jumping a little bit to the US market, bottom up, and then into those sectors, good businesses, trying to find the 1-2 great investments that might be out there for us retail investors. So I have looked at the Amsterdam Stock Exchange. I analyzed stock by stock, all of them, and you can find that by going to my blog, svenkarlin.com. So just click on blog, and here are 2 fixed articles, but here is the last one I published on the Dutch stock market, and you can get there quickly to the list of all the stocks traded on the Dutch stock market. A little bit of introduction, and here you have most stocks with articles. Then, as it took really a lot of time to write articles, then I went a little bit faster just with some notes, but you can get a lot of information if you are interested in the Dutch market or into single stocks. Many of these are also traded in the US. So a lot of work went into this, and here we want to discuss the details. Just a note, why do I go stock by stock? Why do I start with the A's? Well, because that's the way to get to 30 billion.
Mr. Buffett, how can I make $30 billion?
Start young. I would do it exactly the same way if I were doing it in the investment world. I mean, if I were getting out of school today and I had $10,000 to invest, I'd start with the A's. I would start going right through companies, and I probably would focus on smaller companies, because I would be working with smaller sums and there's more chance that something is overlooked. But that's the only way to do it. I mean, you have to buy businesses, or little pieces of businesses called stocks, and you have to buy them at attractive prices, and you have to buy them, and you have to buy into good businesses. And that advice will be the same 100 years from now in terms of investing. That's what it's all about. You have to think for yourself, and if you do, you'll find things.
And apart from getting to 30 billion, I always find something interesting, something, okay, this is different. Why is the market seeing this differently? The benefits are higher, it's a good business prices, and that's exactly the mispricing of the market, is exactly what we discuss, what we take advantage of, and what makes us richer over time. Don't forget, you can check the links and everything, the research. Some little is premium for my research platform, but most of it is free for you to read there. And also, if you go to my research platform, then you scroll down, here is an explanation of what I do, then you scroll down to the curriculum. Then if you click here at the bottom of the curriculum, yes, a lot of research has been done till now. I have put the most of those analysis and discussions under preview, so it is for free, and a lot of articles are already published there for free, especially the earlier ones. So you have a lot of content there if you want to dig. The link to everything will be in the description below. So my strategy is, as always, to find businesses that are worth following over time, perhaps creating great opportunities, maybe not now, maybe in 10 years, 5 years. That's what I do. That's the goal of my research. And also, I think I can get to better returns than an index. Let's start discussing the index. So the AEX Amsterdam Stock Exchange Index, 25 constituents, you can see here the weights at the end of June 2021. And also, not to forget, in the link in the description below, you can download this template of mine, Excel template, where you have a lot of valuations also for companies that I have analyzed in the Netherlands. And then if you click there, you also have a template for a valuation. You can play around, and you can also put your own stocks here. So that's completely free to be downloaded. And you can pause this part of the video because all of the stocks of the index I have commented there and discussed, okay, what can there happen. There are some growth stocks like Adyen, there are Just Eat Takeaway, just Grubhub that we discussed in a video. There are a lot of banks and insurance that pay good dividends, but I find them very risky. As Charlie Munger would say, usually banks go bust every 50 years and insurance companies every 30 years. And in the Netherlands, where you have this loan to house ratio of 100, in the Netherlands you don't need a down payment to buy a house. That's a business model that will break one day, or the euro will break, or the Netherlands real estate. So that's extremely risky for me, and that's also why I would avoid such exposure despite the 5% dividend. Perhaps that's also the risk is the reason for the 5% dividend. Then you have good businesses, most are pricey, there are a few cyclicals in the market, and when it comes to index funds, my issue is always weighing. So if you buy the AEX Index, 40% is in free stocks. ASML, that's now the biggest weight in because it did so good over time. But it is relatively expensive if it doesn't continue to deliver on those promises. Royal Dutch Shell, which is an oil business, but it's not the best. So there are much better oil businesses. This is legacy issues and whatever. So 10%. And then Unilever, really a stock that I don't like. It's on my blacklist. And there is a video I made. I'll put it in the description below. And since then, also the analysis. So it doesn't do much, even if it has great brands, etc. Also, other is pricey businesses, Relx here, and Adyen. So again, growing fast. There is a valuation here of Adyen that I made a while ago. Here you have it. So it really depends on the growth rates, what is priced in, what will be priced in the future, and then you can calculate the stock value depending on the growth rates here and what the business will deliver. But pure growth stocks, if the growth isn't delivered on, you know how that ends. So that's risky from a value investing perspective. All in all, if you're lucky and invested in the index, over the next 5-10 years, you can get a return of 5% because the good businesses are pricey, having free cash flow yields of 3%, dividends of 1.5%, and a lot of exuberance is baked in the price, and if that reverts, then it gets ugly, especially given the weighing, the exposure in the index. There are some old legacy businesses that are not as good as people think, and there are also cyclicals that are usually have a big exposure when things are good because of their higher market cap, but when things are bad and when the time is to buy cyclicals, then the report is opposite in indexes. Anyway, let's go to businesses. I always tell you, don't invest in promises, growth, or this or that. Invest in reality that you are very sure, or pretty much sure, 90% sure, says Buffett, that it will be there still in 5 to 10 years. Then see how that reality fits you as an investment, as your financial goals, and where will it lead you. And I think that the three stocks we're going to discuss today can beat the AEX Index over the long term. The first stock is Ahold, Albert Heijn, Delhaize in Belgium, also a grocer in the States, so they have a big diversified business. They also own bol.com, which is the Amazon of the Netherlands, strong mode, also pushing Amazon out of the Netherlands, or not entering there because of the competition and their integration in the market. The company might even make an IPO of both, so a different valuation that might also revalue things a little bit. And if we look at the stock, it was extremely exuberantly priced in 2000s, early 2000s. Then they had a mishappening in the United States, almost went bankrupt. But since then it has been slow and steady, compounding up and up and up. It's even up from when I made the video, but the market capitalization is 31 billion and the dividend yield is 2.77%, so good dividend price earnings ratio of 20, good free cash flows, and $1 billion of planned buybacks. On this, it could push the stock even higher, but also increase the dividend yield per share. If we go to our template, I have analyzed Albert Heijn at the beginning of the year, so here it is at the bottom, and I have put as input cash flows 1.7 billion of those directed into now growth, as the company has turned into more growth, but dividends will be there, buybacks will be there, so this could be a little bit lower, 1.5 let's say, and the growth rate should then be a little bit higher, 3%, let's say 4%, or let's stick to 3%, and then the terminal multiple perhaps a little bit bigger, but for a 10% expected return over 10 years, if they make buybacks and pay dividends and deliver on the growth, which they can, the intrinsic value for a 10% rate is of course 20 billion. But if I go to 7%, we are already closer, 6%, 5%, then we are 4.5%. The terminal multiple, if they do it, will be higher, so perhaps even 20 in this market. So we are at a 7% likely return from Ahold. You can play around a little bit with this and you can see that there is value. And given the cash flows, 1.5 billion per year projected over the next 4 years, compared to the 30 billion market cap, that's 5%. Plus, let's say 3% of growth, there you have 8% returns, from 5 to 8%, which should be better than the market's 3 to 5% if the market is lucky. So Ahold will likely beat the market over the long term. The link to the analysis will be in the description below. Alright, the next stock is coffee maker tea, JDE Peets, Douwe Egberts for the Dutch people, or the Peets coffee chain in the States if you're familiar with that. So a pretty stable business, coffee, tea, has a big market share, global coffee, more than 10%, and that's, let's say, kind of a moat. It's difficult to compete with that. Likely profits will be lower because of higher input prices because of inflation, but that should also stabilize over time. And I have discussed this in a video where we discussed also the relative versus absolute investing, and now we are doing the hands-on video on that. And JDE Peets, if you look at the business with ups and downs, crisis recent, so it makes $1 billion in free cash flows per year. And if I calculate that 1 billion divided by the 12.5 billion market cap, we are, from the cash flows, already at 8% free cash flow return. The stock has done badly over time because it's a recent IPO. Some funds have decided to make it public, many unloaded it, and the market is also selling because they expect lower earnings, but still earnings next year. When things normalize and the business grows, 8% free cash flow yield plus a few percentages growth, this could be a double-digit return over time. The next stock, Signify, another forgotten stock, as this was a spin-off for Philips. They make lighting, light bulbs and everything related. The market cap is 5 billion. The dividend yield is high, 7%. And if I look at the free cash flows, they are around, let's say, 600 million euro. 600 million euro compared to the market cap, that is a return above 10% in free cash flows, and therefore also the strong dividend there. But over time, if they keep their market share, if they keep doing good, it will lead to higher single-digit returns over time. And I have sent myself an email with this video, with the notifications here. So we have companies that will likely deliver real business returns that are in the high single digits, from 5 to 10, perhaps even above. If there is some exuberance, then you might reallocate your positions in the portfolio. But I feel that this might do better, at least from a risk perspective, than the index fund over time. So more certainty, not as pricey as the index, and this is what is investing for me. The AEX Index now is at 776 points, and in 5 years, which should be a good time for the business forces to really show their power over the cycles, over whatever happens, they should be already doing good compared to the index. It will be really interesting to see. Just a disclaimer here, I really wanted to take businesses that I don't own. JDE Peets is on my covered stock list, but I always aim for higher than 10% returns. So 5 to 10% is not my target goal, except for JDE Peets, where there might something happen in the next year or two, investment related, of course, so better buying opportunities. But I really wanted to show you hands-on, and now the core of investing is, okay, how do these investments, how does the index fit you? That's the key question you have to answer when it comes to investing. We're going to do this S&P 500 and many more stocks, especially over 2022. Subscribe, smash that notification bell. If you're interested in saving time not watching videos, check my research platform where you get 1 email per week. This is it, bam bam, and it saves you a lot of time. Don't forget, prices are going up, so you can lock in your yearly subscription by the end of this year. Thanks, and I'll see you in the next video.